Hi, welcome to our first podcast, the Elite Wealth Podcast. I have here Victor on my right and my brother Michael on my left. And we're going to talk about a lot of exciting things. First of all, I just want to start off talking about what we did this last week. Anything interesting? Patrick, where'd you put your tractor? In the swamp? We had to take the John Deere. We had to take the John Deere out there and pull it out. We had to do a little rescue mission. A little bit, yep. It was pretty well buried, and I had to get my big brother to come help me get it out. So,
what were you guys doing out there with the tractor?
Oh, we're trying to put up a stand. We have two of them. We're going to put up, and we got one up.
So it took three days to put up one.
3 days
to put up one stand.
So it wasn't too bad, but it was fun. It was kind of nice for Mike and I to kind of hang out and work on some stuff together. And I had my son's half brother Lane help us out, which was great too. So got quite a bit accomplished. It was actually a really good weekend. Had a good time.
Wait, so you got your tractor stuck, and then you had to go home to get Mike's tractor.
Yeah.
And then okay, that makes sense. Gotcha.
Yeah.
Lots of chains. Lots of chains. Yeah. Nice. So nice. And while we were doing it last night, two shooter bucks came in over at my stand. So they must have known I wasn't there. How about you? You said you were going to shoot one this weekend. How'd that go? I had, what was it? Friday and Saturday, I had the shooter buck I'm after come out at 5:30 each night. And of course, I go out there and he doesn't show up.
Of course.
So that kind of sucked.
Yeah.
But we'll keep after it.
Well, if you can tell that we do like to go hunting, we have some other sports that we enjoy as well. So we always like to start off the podcast with a little something personal from each of us. Today, the topics we're going to cover is Victor's going to be talking about the rate cuts and what that all means. Michael's going to be talking about taxes and Social Security. You may have heard that taxes on Social Security are going to be cut, but they were not. And then I'm going to talk a little bit about the government shutdown that is looming as well. So, Victor, if you'd like to get started on the rate cuts, that'd be awesome.
Yeah, we can start there. Basically, we wanted to talk about rate cuts today because it's kind of been a hot topic going around. Everybody's talking about them, whether you're trying to refinance your mortgage, lock into a long-term fixed index investment. So, the interest rates dropping does play a big part with what we're doing here at Elite Retirement Group. So I think a few of the big things to remember when it comes to rate cuts is, like I mentioned, if we have some cash sitting out there, or some money coming due here that, we want to keep safe, we want to get a fixed guaranteed rate of return, now is going to be a good time to do that because from what I've read, I don't know if you guys have read, but obviously they cut rates a quarter point so far, and the plan is to keep cutting them this year along with 2026, right?
So are interest rates on mortgages going down now? Have you seen much of a drop in that?
I saw a little drop when it comes to the mortgage side of things. Now, one thing you're going to want to watch when it comes to mortgage rates is they don't follow exactly what the Feds decide to do with interest rates. But a good place to look if you want to figure out if refinancing it's a good time to do that would be to look at the 10-year Treasury. So mortgage rates are usually about 2.5 points higher than the 10-year Treasury. So, if you're someone out there that has a mortgage, going to plan on keeping that mortgage for a while, and you're thinking about refinancing, you can kind of look up that 10-year Treasury and figure out if that's a good thing to do. Not only mortgages, but if you have a lot of debt and you want to consolidate that debt, if with rates dropping, it might be a good time to do that. So I think the two biggest thing when it comes to rate cuts is one, do I want to lock my money into a long-term fixed rate investment where I'm going to get that 4 or 5% for the next 2, 3, 4, 5 years, and then two, refinancing some debt you have. So with rates continuing to drop, we're going to continue to keep our eyes on it, but just know that things are going to start changing here with rates cutting, I think.
So what do you think about the idea of where they do a lump sum? So if you do a balloon type of loan, or maybe you take it out for 4 or 5 years, hoping interest rates drop, and then refinance, what do you think about that?
I don't know about you guys, but I'm not a big fan of balloon loans, just because even if rates are low and the balloon hits, it's not always going to balloon into whatever their current rate is. I think I'm correct there. So, we're not bankers, but we have a pretty good idea with how, banks like to loan money. I actually have a minor in banking. But when it comes to taking out a loan, I'd be a little cautious when it comes to the balloon side of things because you never know what it's going to balloon into. I actually have some clients right now that have a balloon mortgage. And 5 years from now, that rate that they have is the balloon's going to pop, and they don't know what the rate's going to be. So we implemented a strategy to actually get that loan paid off before that happens. So I'm kind of anti-balloon loans. I don't know how you guys feel about that.
Well, I have a lot of times for recreational land, I have a balloon loan. It's 10 year, so it'll be coming up in 10 years. But I think where people may use it more is if it's something that you're not going to stay in and you're going to get out of, you're going to sell, you maybe are going to flip, maybe you're going to do something a little bit different. Maybe not a bad idea to do a balloon. The markets are still pretty good. We'll see if they continue to do well.
I just think that, lowering interest rates, at least around here, the housing market's been kind of tight as far as, people bought houses or refinanced. They have their rates locked in. They've got that 2.5–3% interest rate. Nobody wants to sell. So it's just locking it up. And I think that the economy definitely could get a little boost if we start seeing more houses move. Because if you think about it, you move, you move from a house, you got to go buy all the stuff. You do all these projects you do. So it definitely can help, I think, the local economy and jobs, I think, for sure.
Yeah, I think that too. Historically, what we've seen is September is a pretty poor month in the stock market. But because of the rate drops, it's held pretty steady and actually went up a little bit in September here. So what happens when the government drops rates, it kind of artificially stimulates the economy. So what that basically means is if we have lower interest rates, the small and mid-cap companies and the large-cap companies can take out loans to grow their business at a lower rate. So when you drop rates, usually that correlates to the stock market going up. Again, there's a lot of variables at play when it comes to the market, but I think that's probably why we've seen a good year in 2025 so far. So keep that in mind too. When rates drop, usually helps the market a little bit.
Yeah, especially those small and mid-cap companies that just don't have the capital. They definitely can use the loans then and get them at a cheaper rate so they can spend more money on the R&D side. So anything else that, like when it's financial planning, I know I hear people say sometimes when they're going into retirement that they, think that just you have a house paid off. They don't want a loan. So is that something you still find to be true? Is that something that with the higher interest rates, you think that's a little more value to get that paid off?
Well, the answer to that question is my favorite answer. It depends, right? Different for everybody. That's a really common question we get is, should I take a lump sum of money and pay off this debt I have, or should I leave it invested? And kind of the general rule of thumb there is if the rate of return on your money is higher than what your loan rate is, then we typically don't want to do that. But again, it depends. I have some clients that just want to take a chunk of money, get rid of their debt. They're debt-free in retirement. Some clients are okay with paying that monthly payment. So I think you just have to sit down, look at the numbers, and figure out what's going to be best for you. But the answer to a lot of questions is it depends.
I had a client that came in, and actually it was after the fact, but when you make large purchases and you move money from one side to the other, or you're investing in property or something like that, I always look at, involving us as a discussion, call us up and just say, well, hey, I was thinking of doing this. They actually missed out on using a 1031 for a tax strategy where they had bought a house in Florida, put a bunch of, got a huge amount of capital, improvement as far as, the property down there in Florida going through the roof, right? Mm-hmm. So then they went and bought another one and they missed out. They had to pay a ton of taxes on capital gain. So besides just, when to take the money out, just involving us to help make those decisions so maybe we don't miss things like that.
Mm-hmm. Yeah, we get asked all the time, clients will call in and say, hey, I'm thinking about buying a new vehicle. Well, one, you have to look at the rates, and then two, what we really dive into is the tax side of things on top of that. Because when our clients retire, we like to have them have money in all three buckets, from a tax standpoint, or tax deferred, taxable, and tax free. So yeah, we'll look at the interest rates. We'll look at, if it makes sense to just take a big lump sum. And if it does, we have to make sure we pull that money from the correct tax bucket too. So we always talk about how all 5 areas of retirement, play into each other. So, every change you make to every part of retirement is going to affect every other area. So just be really careful when that stuff comes up.
Yeah, that's a really great segue into what Mike wants to talk about next. So,
what was
Mike,
that?
why don't you, right?
No. So the Social Security, everybody was hoping Social Security was going to be tax-free. So now, under this new tax reform, the big bill is, are we going to have, no taxes on Social Security? Well, number one, Social Security for most folks, if it's going to be taxed, is only taxed federally. We don't have to worry about state tax on our Social Security. And for some of us, if we have lower income, we have no taxes. That none of our Social Security is taxable, and it can scale up from 0 all the way up to 85% of our Social Security is taxable. So we've always wanted, we've already paid taxes on the stuff, right? I mean, that's the kind of the complaint. We've paid taxes on it. Why are we paying taxes on our Social Security again? So that was the movement or the thought. Let's see if we can make our Social Security tax free. Not really. We hoped that, but we didn't get that. So what they did instead is, if you are 65 or older, you get a tax credit, basically like an addition onto your standard deduction of $6,000 per person. So for a married filed couple, both of them are 65, you would get that $12,000 added onto your standard deduction.
Yeah, so it's an addition to the standard deduction. If you don't use it, if you're in zero, you don't get any money back. You just don't use it then, right?
Correct. Yeah. So you don't get more money. They aren't going to give you $6,000. You just get to subtract that from your taxable, your AGI, basically. The drawback is there's a couple. One is it only lasts 4 years. So this, the tax incentive, the $6,000 added onto our standard deduction, will run out in 4 years. The other is there are phase outs to it. So if we have too much income, we're not going to receive much or any of that additional tax help. For a single person, it's $75,000. So if you have more than $75,000 of adjustable AGI, then you will have start to phase it out. And by the time for single you hit 175, then you have no benefit of it at all. So you have to be aware that it may not help everybody, but I guess it's better than a sharp stick in the eye.
Well, that would hurt, yeah. So, right? But that's a nice reason why we have Abby here too, right? Because things have now gotten a little bit more complicated. And that phase out and what you can do, what you can't do, that's really going to play a major role. So maybe if you were doing your taxes before, maybe you don't want to do your taxes.
Well, nothing else. We should at least be talking about strategy, because if we get an additional $12,000 of standard deduction, is there room to do more Roth conversion, right? So moving money from our IRA to Roth. The drawback, we have to watch that too, though. If we are doing IRA to Roth conversions, now we have to kind of take that into input. Okay, did I do too much? And now I lost that $6,000 additional standard deduction, because as a couple, that's $12,000. So it'll add, really, to me, it's almost like a third line of things to look at. One is when we do an IRA to Roth conversion, we look at tax bracketology, right? We made up the name, but anyways, tax bracketology. You look at your brackets and you feel, okay, I want to fill the 12%, the 22, or the 24%. Once you're basically 63 and over, then we have to look at tax brackets and Medicare IRMA costs, which IRMA is the additional premium for Medicare.
Aunt Irma.
Yeah, Aunt Irma. The additional premium for Medicare. So Part B and Part D for drugs, you can have an additional cost each month for that if we have too much income. And then the third bracket now we're going to have to add to that is the Social Security standard deduction, I guess you could say, is if we go too high with our conversions, we could be losing that $12,000. So there's going to have to be some balance point. I was thinking about it. It kind of makes my head spin just a little bit. So I just think we have to really be involving, one, software, and two, a professional like Abby to come in there and say, all right, this is what bracket makes the most sense.
Yeah, and that's something that's a big deal. And I think, as far as how we help folks with preparing for retirement, and actually the big one is turning 75 for some, 73 for others, when it comes to when the federal government forces you to take money out of your IRAs for the minimum distribution. Anything that you think, can you think of anything that would maybe be beneficial for folks that are looking at soon or becoming 75, 73 pretty soon, where they have to take it, that this law now or this change can really help them?
Well, we want to take it and I guess, get all the credits we can. So one of the things, if you are turning 75 or 73 and getting your RMD age, if we want to start giving that away to charity to help us with our income. So qualified charitable donations. A great example, you go to church and, you give them some money every month, and you look at the end of the year and you're like, oh, we gave church, $3,000, $4,000, $5,000, but you gave them that out of your pocket. So you paid taxes so you actually maybe took out 6,000 to give them 5,000, right? And maybe instead take the 6,000 direct out of your IRA. You can't get it. You have to send it directly to church or to your charity. They receive it. They get the full 6,000. The winner is you get, you don't have to pay taxes. It doesn't count as your tax bracket. So maybe if we're trying to sneak in some of these brackets that we're looking at, either IRMA or our tax brackets, that we can slide that income down a little bit. And again, what's the benefit? The church gets more money. They don't have to pay taxes. Maybe we get a seat a little closer to the front. But that's the way I look at it. And as far as like the taxes, I know we talk a lot about taxes here, but Victor, one of the most powerful things that you said to me, we were talking just in the office BSing, and he's like, taxes will be the biggest bill you have for your lifetime. We all complain, how much your rent costs, how much this, mortgage costs or car payments and all that, but don't realize until you actually start looking at some of our programs, our software programs that we have. The Income Lab is phenomenal, but you can see, okay, I'm gonna my lifetime I'll pay this much money, and over the lifetime of my money. So like when I have it and then I give it to my beneficiaries, this is how much they're gonna pay in taxes. All of us. It's scary, and that's if taxes don't go up.
Well, it's crazy. I mean, if you retire with $1 million in your 401k, you have about $500,000. So we really try to implement as much as we possibly can to save our clients as much on taxes.
Yeah. So what do you mean by that when you say that you really have 500,000? Expand on that so people that may not know.
Yeah.
What that is.
So I mean, most people retire, and retirement's different now. So back in the day, you'd retire with a pension, Social Security, and some cash at the bank. And now everybody's retiring, and you have these big 401ks, 403bs, IRAs. So all the money in those accounts is tax deferred, meaning you got the deduction when you put it in, but you pay taxes when you pull that money out on the back end. So if you have $1 million in your 401k, you owe tax on every single penny in there, all the premium you put into it, plus all of the interest you made over the last 30 years. So when you pull it out, you get hit every way from a tax standpoint. So that's why I just tell people, roughly if you have $1 million, you have about half that, 'cause you're going to give half of it to Uncle Sam, but not if you do, the right tax planning, which is what we really help our clients with.
Hey, Mike, when does that start? When you can start giving money to charity from your IRA? Because you can't do it whenever.
Yeah, is it 70?
70 and a half.
70 and a half
Yeah.
is, yeah. So if you're 65, you can't do a charitable donation from your IRA. You have to wait until you're 70 and a half. So it definitely is a little later in the game, but it still can be it's just one of the tools. So you can do the donations, you can do the, Roth conversions. This is a newer, I want to say almost pandemic, but it's a newer issue because, Pat, now you think about our parents worked in a factory for 45 years. They have a pension and Social Security, and a smaller savings. Now the folks that we're working with, this next, the next generation almost, they really limited pensions. The majority of folks have IRAs or pre-tax money, and it's significant. And it's a new problem. And as we're going forward, a lot of these people are still very frugal. So they're saving their money, and these accounts are just growing. And you take 4% out of a $1 million IRA, and you made 15% in the market last year. Well, it doesn't barely make a dent. It just keeps on moving up and up and up. And as we approach 90 years old, we have to start taking 10% almost as the RMD. So 10%, there's 100,000, and then you add that onto a Social Security check and maybe a loss of a spouse. Now you're filing single tax brackets. Really scary to think where the taxes are going to go with that.
Well, speaking about taxes, the last topic we want to cover today is what are they doing with our tax money? Well, They don't know yet. So that's kind of the bottom line. Government shutdown possibly coming. It seems like every time we turn around that they're talking about potentially the government shutting down because they can't agree on how to allocate the funds. So really what it is that we had earlier this year, the one big beautiful bill come through, got passed, but that's just the bill, the spending bill. That isn't the actual allocation. So what happens is that Congress has to appropriate the funds, and then you have to have the Senate ratify that. Well, it looks like right now that that's going to be pretty tough to do. There's a lot of senators that don't want to vote for it. And what I mean by it is the continuing resolution, they call it, the CR, which what that's going to do is give them more time to allocate the funds where they want them to go and be able to come to an agreement. So they set aside a big block of dollars and they say, now this group is eligible for these dollars, and they just spread it out. Well, they haven't figured that out yet.
It's so bad that they're actually the shutdown's even impacting our timers here at the office. Do you notice?
Yeah, it's our timer. Our
even died.
Timer shut down.
Well, we're going.
But really, the big thing is that what's going on is that they want to get what's called a continuing resolution, and they just want it to extend spending at the current rate for a period of time. Sounds like 7 more weeks, so they can figure this all out. Now, if they don't do that, this can be really, really impactful. It can be really, really a big deal for folks that are relying on, your Social Security check. If you're in the military, your paycheck. Anybody who's a federal employee is really going to be impacted by this. The last time this happened, it was pretty catastrophic. It really did impact our lives on a daily basis because all the things that we get from the government as far as services just really came to a grinding halt.
So what exactly happens if the government were to shut down? How does that affect us?
So what they do is that everybody who's non-essential and all non-essential services, what happens is they're stopped. They close the door. You can't come to work. Nothing happens. So they're basically only going to be keeping the lights on in areas that are just absolutely critical for infrastructure. Of course, they'll keep on printing money. That they'll do, but it's not good because a lot of people depend upon that. Even like Haley she just had her Medicaid renewal and they messed it up, and we're trying to get it fixed, but now that'll come to a stop. And we're gonna have to wait and start almost all over again because they did not renew her at the correct class. And we have to go do that. And that's just a nightmare. So if we're dealing with that, what about somebody else is in the process? What about, veterans that have had, an award and they're supposed to be getting services and they don't get them anymore? Those checks aren't going out in the mail. That's a big deal. Social Security. What if all of a sudden your Social Security check stopped? So it's really I think it's a bad idea. It's just, we don't want to see it no matter who's which party's in charge. It's not a party thing. It's just, I think, bad for the country.
I think it is a bit political because they use
they
use this as totally a chip.
They both do on both sides.
Yeah, both sides. But they're like, oh no, we're not going to do this until I get what I want. And they use it as a pawn, and then basically
leverage,
the people that are impacted are, like you said, people on Medicare, Social Security. A lot of the time, it's lower.
The people that need it the most.
Yeah, 100% need the money the most, and they're not thinking about that at all.
Yeah.
So correct me if I'm wrong too, but because we don't want to scare people too much, right? Most likely the government won't shut down because doesn't that mean too that the politicians stop getting their paychecks?
Oh, I doubt that.
Right?
I don't know about that. But if they did,
they probably have some extra cash.
They probably have some extra cash here and there. I don't really think that they're too concerned.
But it's probably unlikely that the government does have a shutdown.
I mean, odds, I would say right now this year it's like 50-50. I think it's pretty high. I mean, a lot of the rhetoric that's coming out right now is not positive for this. And here's the other thing that's a downside is we have only 2 days that the House and Senate are in session left before it shuts down because for this week they're out of session for Rosh Hashanah. So they're nobody there this week. They come back and they have 2 days to get it done.
So if the government shuts down, does that affect the stock market at all?
Yes, it's a great question because what will end up happening is that the stock market will become very, very concerned and volatile, and I think you'd see the markets actually go down 4, 5, 6%.
Well, that wouldn't be good.
No, and the longer it drags on, the worse it gets. And we could take this budding into a nice little rally here, and it could totally blow it all up, and we could be looking at something completely different. I just don't know that. Again, I guess I look at it from an apolitical standpoint. I just think no matter who's doing it, it's a bad idea because it hurts us, the people that need it, and that's just a bad idea all around. I mean, get your act together, get it done. People are depending upon it. Lives can be really upended if it's not taken care of, and this is maybe one of those things they shouldn't be playing too much politics with.
I think it's, to me personally, I think it's a little bit of a disconnect with the politicians and the average Joe.
Oh, yeah.
They really don't understand what it is to be, there's a lot of people out there live paycheck to paycheck. And so that's why, like I know when we always talk planning and people talk about where's money, is that emergency fund, always having that money there, how important it is, because, this is no control of your own. This is a legislative impact that would have, that could impact your family, and to always have that extra emergency fund sitting there, that's so important.
Yep. Well, I guess we don't want to get too much more heated on that topic. So what we're going to do is we're going to thank Michael for being here as guest this week. We'll probably see him back here and there. We'll see Matt on our next podcast. He's going to be a little bit more of a regular. Victor, thank you for sitting in today as well. And for myself, Patrick, thanks for watching our first podcast of Elite Wealth Podcast.